This will be our last session together for a couple of weeks. Next Monday, my wife and I leave for a trip to the Elbe River. We started out in Prague, and I guess we get all the way to Berlin before we're finished. So we'll get a chance to see a bit of what is happening on the continent and the economic climate there. As I was just saying to Michael, what I've been reading is that the rising interest rates in the United States is causing a real increase in the value of the US dollar, which is great for someone like me who's going to be traveling overseas, but not so good for exports. So it's right now we're in precarious waters in terms of the economy, and everything else that we've been talking about in the last 4 or 5 weeks is also coming to a head at the same time. The property market stress. I left you last week with this chart, and it just shows the record increase in the number of people who are purchasing second homes. Some of them are using those second homes for income. They're using them as investment properties, and eventually they might be deciding to sell their primary residence and move to this second home if it's in a resort community in Florida or somewhere else. So this is a part of the economy that is siphoning off a lot of income and wealth that might be otherwise used, but it's certainly a characteristic of that portion of the U.S. Households who have a lot of spare assets to spend, enormous equity in their residential property, an investment portfolio that maybe now stocks are down a bit, but fixed income assets are up. So people are probably rebalancing their portfolios, or their financial managers are doing so, in order to take advantage of the interest income that they're able to get on CDs and government securities. So this is something that I'll continue to watch. I mentioned to Ibrahima that my intention is to repeat this series of lectures once a year for the next several years to see whether or not the analysis that I presented and the stresses that I've been identifying are going to get worsening as we get closer to 2026. And so hopefully it'll give a time record of how true these signals are that are going to tell us whether or not 2026 is the maximum stress period for the current economic cycle. So there's a lot more to discuss. And when I return from my travels, we'll have 2 weeks to really talk about potential solutions, policy measures that can be put into place to try to mitigate the worst of the crash, if it in fact occurs. Whether or not politically any of it is possible is hard to say, of course, but at least those of us who are participating in these lectures and discussions will have some insight into what might be done if we can only get the political will to do it. So the next thing I want to talk about is the impact of working remote. Not just in the United States, but certainly in the United States, there's a huge number of people who have now gotten accustomed to working remotely. It was beginning to happen certainly before the pandemic, but now there are many people who've gotten very adjusted to the idea of working at home or working away from the office, whatever. And they only occasionally meet in person with their fellow workers. So what are some of the implications of this phenomenon that's happening? Well, one is that the dramatic increase in the number of people working remotely has stimulated what is being described as an exodus of workers from the nation's most expensive urban centers. And depending upon the numbers, that would suggest maybe a dampening of apartment rentals and housing prices. But even though that may be a longer term outcome, as of right now, we're not seeing that even as mortgage interest rates rise. Apartment and single family residence rents have continued to climb across the nation, with an average increase of 14% last year in 2021. We're still not seeing enough increase in supply to really counter the shortfall. If you remember last week, I mentioned that the Low-Income Housing Coalition estimates that there are about a shortfall of 7 million affordable rental units for low and moderate income households in the country. The value of most housing should be defined as its replacement cost less depreciation. That's kind of a standard in the sense that if you live in housing that is easily replicable, in other words, it doesn't have any historic characteristics. It wasn't designed by a famous architect or whatever. A house, the value of a house, if an appraiser is doing their job right, it's what does it cost to replace this unit and how much depreciation is being shown by the wear and tear on the property. How old is it? How old are its systems, its roof, and all of that? So in this chart that reflects total property value, the housing unit is included plus the underlying land. So what we don't know, and generally the statistics that are available to us, is what portion of property value in any community is made up of the depreciated value, aggregate value of housing units versus the aggregate value of underlying land. Appraisals do capture this information, but it is considered proprietary. And so if you want it for an analytical purposes, you generally have to pay for it. Some buildings command a premium over this depreciated value because of their historic or architectural uniqueness, as I mentioned. So here's the birthplace of Henry George in Philadelphia, with a historic marker outside of it. This building was owned by the Henry George School for a very long time. And for many years, it was the location of the Philadelphia extension of the school. But for all sorts of reasons, my conclusion is that the school went into competition with community colleges and other degree and certificate granting institutions. The attendance, people registering at the Henry George birthplace in Philadelphia, began to really fall off by the early 1980s. And eventually the building, it just became too expensive for the school to keep it operating. It was unfortunate, but at least the school found a buyer for this location and made a significant increase in the school's corpus because of it. Well, what was this building worth? What was its replacement cost? Well, it had certain historic characteristics that had to be maintained, both the facade and some of the interior, but mostly the value was in the location. Probably, I don't know what it sold for, but I would say probably at least 60% of the value was in its location. And that's typical of a lot of residential buildings located in the center of cities, whatever country you're in. In some market areas, the land portion of the value might be as high as 80%, or even higher than that. So it just gives you an idea of how much land value there is out there, and yeah, how that affects the economy when the value of land is undertaxed and the net imputed rental income can be capitalized by the market into a selling price. So in general, the reason why two identical or even similar properties sell for very different prices is the desirability of the location. Here's a photograph of a typical subdivision of single-family detached housing units, and the prices that these units sold for are somewhat different. There might be slight differences in amenities and whatever, but for example, is the property on a cul-de-sac where there's no street traffic? That might increase the land value. Is it a corner lot? Is it near or far from the main highway, so traffic noise is lower? So all those factors, of course, would come into play to determine why some of these properties that look virtually the same might have as much of, and here's one, the difference, $399, and the high point on this map, on this photograph, is 428,000. So why would those two properties be so different? Well, we don't know. So generally speaking, what disappears when property markets crash is the speculation created land value. And that's what occurred in 2007. And that's what will occur in the next major downturn, whether it's 2026 or shortly before that or shortly after it. For persons and private entities, one of the most serious threats to financial stability occurs when the level of debt cannot be serviced out of income. When this occurs, private entities, businesses close down or try to obtain relief in bankruptcy court. Bankruptcy is also an option for persons. However, some forms of debt cannot be discharged by bankruptcy. For example, in the United States, student loan debt has been a major exception. So if you graduate from college with $100,000 worth of debt and you're unable to find employment for a while, interest is going to accrue. And maybe down the road, you still owe a good bit of that $100,000 and you lose your employment for 6 months. Now you have a real problem. And you might declare bankruptcy, but you're not going to be able to get away from that student loan debt. There's a lot of legislation being considered about all this, and we don't need to go into that. The public debt has its own unique characteristics, of course. And if you remember early on, we were talking about the attitude by the modern monetary theorists that this public debt is really something that we shouldn't worry about. How the US government and the Federal Reserve will react to the federal government's debt is really what I think is a wild card as the economy approaches other maximum stress points at the end of the current economic cycle. We're at $30 trillion and growing. Like Stephanie Kelton says, if the government wanted to, if the Federal Reserve wanted to, it basically could just cancel all of the debt that it holds, or it could go into the credit markets. It could actually create new money and go out and buy all of the government debt that's privately held and then just write it off. And would the economy be worse off, better off? What would be the ramifications? There's a lot of discussion about all of that. But I would say, look at this chart. Here's what we face all the time. This chart says there's debt ceilings that have been established and then just ignored. Reality comes into play. Every time the Congress of the United States establishes a debt ceiling, within short order, they have to increase it. So it's constantly being upped. And there we are, ready to hit $30 trillion. And what's going to happen thereafter? The federal government has then, by default, adopted the position taken by Stephanie Kelton and the MMT folks, who really argue that deficits do not matter because the nation is the beneficiary of sovereign money. And we haven't, our government hasn't acknowledged that, but, and it's amazing to me how little discussion there is in the media. MMT is not something that you hear about. None of these issues outside of sort of economics conferences or reform organization conferences, but the mainstream media isn't covering this issue at all. And our legislators, particularly on the Republican side, on the conservative side, talk a good game about how worried they are about the public debt. And of course, as interest rates rise and government securities mature and have to be refunded, that means the interest being paid to bondholders is greater. And where does that money come from? It has to come from somewhere. And if it doesn't come from taxes and fees, then it has to be created out of thin air. So what can we say about the role of the financial institution? I think this is a great image. There's former Chairman Bernanke and Paulson from Goldman Sachs, and one of our fellow citizens in the back, wanting no blank checks. What does that mean? Well, it means that that he was one of the many people who were fed up with the bailout of the large financial institutions, while the average person was not being very well taken care of through no fault of their own. There are, I think, serious risks associated with continued monetary expansion, and where the spending occurs will play an important role. So questions to ask are, will the money needed be spent on infrastructure repairs and replacement? Will it be channeled to states and local governments to construct the millions of needed affordable housing units, to upgrade schools and for anti-poverty programs? Will the money be given to those who are having the most difficulty meeting basic living costs? Or will the money again be channeled as previously to prop up the property and financial services sector when the next crash occurs? Those are the political questions with economic implications. And we have a midterm election coming up, and the results of that midterm election are going to have a lot to say about which direction the federal government takes. And in each direction, there are dangers. What about the universal basic income? Well, there's a lot of discussion about the wisdom of providing a guaranteed income to all, this idea of a UBI. By proposing that this income is granted to all persons, or basically all adults, the political gamble is that at least some of the haves in our society will use their influence to see this measure is adopted. Those at the lower end of the socioeconomic scale will, it's assumed, experience real improvement in their lives. And the question I ask is, will they? Now, I have an answer, and maybe some of you will have anticipated what that answer would be. Anybody care to take a guess? I'm giving you a big clue here.
May I?
You may.
Okay, my guess would be if you provide a minimum basic income under current circumstances, prices will merely rise, matching that increase in income on everyone, including rent.
And
That's my.
I would only make one correction, and that is I think the rents will be the first source of increases in cost of living.
Yep.
I agree.
You'll be subsidizing the landlords.
Absolutely. That's exactly what will happen. And the only way that can be obviated is if the government commits to significantly increasing the supply of affordable housing by providing extensive subsidies. And again, the likelihood of that occurring is higher if the Democrats win the midterm elections and is almost zero if the Republicans win the midterm elections. But it's just a basic, economics equation that you increase the demand side of the market without increasing the supply side, and higher prices will result. And there's a limit, of course, to how much the rents can be increased, because landlords don't want a high vacancy rate. What they're going to look at is how many people do they have in their waiting list to get into their apartment units that come up for renewal of a lease. And so if they increase the rents, will their existing tenants move out? Will their existing tenants be able to absorb that increased rents? Or if they do move out, will somebody else be able to move in and afford those rents? Joe.
Obviously, the market will charge what it can bear. So wouldn't the response have to be some kind of rent controls? And rent controls would increase the pressure for people to sell their property in conjunction with land value taxes, because they're losing on the land value taxes and the rent controls are preventing them from recouping it. And of course, the rent controls would prevent the subsidies from moving on to the landlords.
Well, you may have a stronger social cohesion in Canada than we have right now in the United States. So there will, in my view, there will be organized and strong resistance to either rent control or rent stabilization. So that really does leave new construction as the best option. The other, there's two ways to go: direct public housing, so that cities could, with state and federal assistance, they could put up public housing on land that they already own, or they can simply provide financing for investors who get a low income tax credit. So we'll probably see some of all of this if the Democrats in the United States manage to win the House and the Senate. And at the state level, the same issues are occurring as well. In those states that will end up with a state assembly or a state legislature dominated by the Democrats, public money may be forthcoming. Even a UBI might be forthcoming at the state level. These are all, what if scenarios, really. I don't know. Did I answer your question well enough, Joe?
You've certainly covered the alternatives. I still feel that rent controls is a way of helping the Henry George plan, because it's another pressure on the land from being better use.
Yeah. Well,
I have a question to you. I think it's more directly toward Joe's comment.
Yeah,
But
go ahead.
if you have rent control, then you are not resolving, you are not addressing the demand, but you are acting on the supply. So if there is rent control, nobody would want to build to lease. And it sort of reminds me of a comment made by a Swedish economist who said rent control is the second best way to destroy a city.
Yeah.
And the first one actually is to bomb it.
Yeah, well, this is the distinctions that has to be made between, for example, rent control and rent stabilization. So if you have a financial formula that allows for increases in rents to cover any increases in operating costs, then you can combine that with some tax abatements to the owners of the building that might enable them to retain their profit margins without increasing the actual rents charged to the tenants. There's all sorts of ways to get to try to reduce the problem of the disparity between supply and demand and need for housing. But you know, I do agree with the assessment that rent control, what it does to the owner of a building is provides a disincentive to do any improvements and to maintain it. So you could have a building that particularly in a lower income neighborhood that would end up in what we might call slum housing, which certainly happens all the time now. And eventually those buildings which are not maintained, the local code people come along, the licensing people, they fine the owners for code violations until eventually the building becomes uninhabitable. They evict all the tenants and they board it up. And now you've lost that particular, building for the supply of affordable housing, which makes the pressure on the other buildings even more. Not an easy, thing to solve as to how it affects land values generally. If you take that building out of use, obviously it is going to have a tendency to increase the land value underneath other buildings that are in a contiguous area because you've taken that property out of the market. But it doesn't necessarily mean it's going to help people get into affordable housing. It's got to be an increase in the net supply. The statistic, the Department of Housing and Urban Development a number of years ago issued a paper. This is about 10-year-old data, but they said for every unit of new affordable housing constructed, 2 units came out of the supply because they were no longer habitable and they were abandoned. And you can just take a city like Detroit. The number of housing units that rapidly were abandoned and left empty and deteriorated was enormous when you consider what the city once was. But this collage here I've made, it just shows this is a basic political, economic, and social issue here in the United States. And there's a lot of conflict between tenants and landlords, tenant associations, landlord associations, over what's fair, what's right. And right now, the situation is that we have a deteriorating supply of decent, affordable housing in many parts of the country. And whether you think the nation's economy is stable, whether it's growing or experiencing recession, there are always going to be personal and business bankruptcies. Protecting ourselves from the unforeseen, of course, and the unexpected is why insurance firms exist. So, we have the statistic on new business startups is about 2 out of 3 fail within the first 5 years. So we're going through that right now with a lot of businesses that have been formed in the last couple of years. The pressures of the pandemic put cash flow pressures on them, and they've gone back out of business. So this is going on right now. And as we move closer to 2026, if business rents keep going up and profit margins keep going down, because, okay, again, here again, we're faced with rising value of the dollar. If those businesses are dependent upon and it's selling overseas, then their revenue is going to decline. It's hard to predict exactly how many are going to possibly go out of business, but we can probably expect that many businesses are going to have hard times again, even though we're past the pandemic. The financial crisis, I want to show you this chart. There's the number of consumers with new foreclosures and bankruptcies, and this is up through 2018. So you can see that the financial crisis that began in 2008 shows that there was a close relationship between personal bankruptcies and foreclosures. You can see the spikes here in the middle going up and how close they are. It doesn't take long between unemployment or other causes of personal bankruptcy and the loss of a house going into foreclosure sale. Between 2008, December of 2008 and December of 2010, about 1.8 million small businesses went under. Between 2006 and 2014, 10 million households lost their property to foreclosure sales. Where did all those people end up? With relatives, downsizing, trying to get by living in rental housing. That's the cost of going up. None of these problems have gone away. They're still out there as we're going through this current economic cycle, and we're going through this current dramatic increase in property prices. Business bankruptcies. Here's a chart that's showing, the peaks and troughs of bankruptcies, but you can see in 2008, 2009, the peaks, and go all the way up they went down as the recession, as we started to come out of the recession. Still, not zero by any stretch of the imagination. And then here's 2020, a peak year during the pandemic, and 2021, not way down, but we'll see what 2022 poses. So the disruption to business caused by the pandemic caused this spike. Another 413,600 businesses filed in 2021. 2020, the number was 544,500. So what is this telling us all? A lot of people need help. We have become a society in which debt is an accepted part of life. Postponing consumption until people have funds are saved is simply not an option for many people. So ironically, when a person's credit score is translated into risk of default to a creditor, the price of credit can absorb income needed for necessities. So, if you're dependent on the use of the credit card, while right now the more interest rates are low, what is your interest rate and your penalties on a credit card if you don't pay off the balance every month. That could be as high as 25%, depending upon your credit score. That's the kind of credit you're going to have access to. And if you're in the group of millions of people that do not have sufficient income to take care of their expenses every month without relying on their credit cards, you're perpetually going to be in debt, and a lot more of your income is going to be siphoned off in interest and penalties. So I guess one of the things about this is I conclude, if only we could choose our circumstances at birth, life's risk would be fewer and milder. But we can't choose where we're born. We can't choose our parents. We can't choose our economic status. And a lot of people in this country never are able to make it out of debt. You know, from the time they're early adults, they're perpetually in debt until they end up in the grave. By the end of 2021, consumer debt in the United States was $15.6 trillion. This is just showing the breakup of the debt: automobiles, bank cards, and first mortgage debt. And it again, you know, it reached a peak right around 2008, and we had a crash. Well, what's happening now in 2022, we'll see as we get towards 2026. If those peaks go up again, we will be poised for another crash pretty considerably. 2021's number was an increase of $1 trillion in debt in 1 year. From 2020 to 2021, $1 trillion of added debt. The Federal Reserve Bank in New York reported at the end of the first quarter of 2022, total debt had already increased by another $266 billion. So it was fast approaching 16 trillion. By the end of the year, who knows what it'll be. More statistics. This just breaks down, you know, where we are by category. So the first quarter of 2022 figures actually show an increase across the board. Mortgage loan debt was over 11 trillion. Student loan debt was about 1.6 trillion. Of that, about 5% was 90 plus days delinquent. People who had the debt just couldn't pay it. Now, we're going to find out how much of that gets relieved by the current decision by the Biden administration. Automobile loans increased to 1.47 trillion. The only fall was in credit card debt, which fell to 840 billion. But even there, over 3% of that amount was 90 days plus delinquent. Let me stop here for a few minutes and see if you have any comments or reactions to the debt situation. And maybe if you want to share what's happening in UK, Michael, or anyone from Australia or other countries is on.
Yeah, thank you very much for that description. What I feel is sometimes neglected is the oligopolistic nature of our supply chain. You've mentioned and I do agree, there will be a rising foreclosures and the bankruptcies, but they will be taken over at a bargain, either their assets or their market channels by these oligopolies. And that kind of frightens me because they'll buy it at a bargain and still, and it won't help reduce prices because that's the nature of oligopolies, to constrict supply so that prices will go up. So that's a major concern. And one of the proactive strategy I have studied in developing economies is, and even in history, is the formation of cooperatives to compete and overcome the power of these oligopolies.
Yeah.
I think Georgism, it's about time Georgism and the cooperative movement think of a strategic alliance, because the cooperative movement also doesn't believe in paying income taxes and other taxes, but they also have principle number 7, which is concern for a community. Now, if they support land value tax and and join our campaign against other taxes, I think we can be quite a powerful force. That's my comment.
Well,
Thank you.
that's certainly a desired hope and a long-term strategy. The reality today is that the cooperatives have not achieved scale. There are many of them, and they're small scale, and they will help those communities that have organized cooperatives, and we have many of them across the United States, but they're still not, they have not scaled up enough to really affect the direction of the economy. So yeah, they should be encouraged, no doubt about it. And maybe giving some forward-thinking legislators could introduce some specific tax benefits that will encourage cooperatives over the formation of limited liability corporations. I mean, that's one of the things that we need. It's the same kind of thing with we need tax incentives, for example, to encourage the rapid construction of solar farms and wind farms over building more fossil fuel powered plants, energy plants. So all of that works together. We have to increase scale, but despite everything that's going on, we're not going to get there before this next economic cycle reaches its maximum stress point. But you're on the right. I totally agree with you. Those are the things we need to be working on, and partnering with the people who understand the value of cooperatives, which is why I have been supportive of what Richard Wolff, has to say about cooperatives. He's definitely a socialist. He has his own sense of what socialism means. There's a lot of his, policy proposals that I think are for the circumstances we're in, are the right ones to help mitigate the problems. We cannot, in my view, we cannot afford to be a purist. I would love to have Henry George's single tax in place, but I'm afraid, my friend, we're going to be long dead before we see that happening. Michael?
Sorry.
A couple of to me, just seems in the 18 and a half year cycle, the peak is relatively a short period. It reaches a real point where we realize that things can't go on as they are. An example of that is people at the moment here in London, someone selling their flat across the road is saying they're having difficulty getting a mortgage because they're drying up, basically, and people are not. But so they're putting their flat off for sale until next year, when perhaps we're being on the down cycle again, and things will start to become progressively or more optimistic. But the peak doesn't last for too long, but it's a wake-up call that we've reached. This can't go on. That's the message I'm trying to put across. And it's only when we start to attend to it seriously that things will start to go down. Then they go down relatively long, and it's a long period, and then we drift into amnesia almost, as though things are going to be good forever. And then the peak starts to come steadily more difficult, and the peak wakes us up. It's not going to go on forever. I just let that point really, hit me in your slides tonight.
The problem we have is there's going to be enormous collateral damage. Every time there's the peak, the peak comes and goes, there's enormous collateral damage. The estimates, these numbers that I'm giving you now scare me to a point, because they're the aggregate effect could bring down the global economy. 2008 was a real scare. 2026 could be more than just a scare. It could be, it could be societal chaos.
That's a good point, actually. Yeah, I mean, it could be so disastrous that we lose the point where we can gradually get back. We get a war that kills so many people, and et cetera, which is what happens when we don't get a grip quickly and come to our senses.
Well, we should be reminded, for example, Americans should be reminded of what we did in 1929 and 30. We passed protectionist trade laws, the Hawley-Smoot tariffs, and we thought that was going to protect domestic manufacturers and domestic producers. What did it do? It sparked a trade war that pulled the global economy even deeper into the Great Depression, because every country then started to react to the same way and say, okay, we're all going to protect our own domestic markets, but the economy is already at that point too interconnected for that to work. And if it didn't work in 1930, how could anyone expect that kind of a policy to work in 2026? Joe.
I would like to go back to rent controls.
Okay. Well,
I'll tell you why. I think there are time horizons with these kinds of things. And yes, in the long run, rent controls with no other features would create what you described, but you're talking years. What has happened in those past United States? Rents have gone up like 20%. And that's just unacceptable. That's just theft. That's just wealth transfer. And there should have been some kind of rent controls. It's monopolization. It's opportunism. There are laws against a lot of other kind of similar behaviors, and that's just not right. Secondly, the rent controls are a way of giving the landlords no option. So if the desire is to put land to its best use, you need some kind of Henry George tax approaches so that people find it too expensive to hang on to the land. And the rent controls just kind of seal the deal, and that land gets sold either to people who will develop it much more dense properties, or the government will be able to buy it because the value of the land, the sale value will go down. Private, nobody is going to buy it just as is because it's just not worth it, but they will buy it. Someone who will develop it or the government will buy it. So I think rent control should be part of this, certainly an immediate part of what's happening right now, given the kind of behavior that's been going on, the profiteering. So just want to defend my position.
Well, conceptually, I think you're right. It is a strategy that could have an immediate impact on the current problem. it might be a strategy that could be passed by the voters in Boston, Massachusetts, or some other strongly progressive Democratic Party dominated city. But even New York City has had its problems with both rent control and rent stabilization. I don't know if there is a political enough of a political constituency to deal with the problem to get legislation passed. So if I was going to write a letter to my congressman about this, I would just support basically an allocation of funding to the cities to buy some of these buildings, even buy them at current market value, and then convert them into public housing, or turn them over to as a limited equity co-op, that kind of thing. I mean, there have been programs like that have worked pretty well. New York had, I think it was called the J51 program, if I remember correctly. Maybe someone from New York can correct me if I'm wrong, but where apartment buildings were converted to co-ops, and they were converted to limited equity co-ops with tax advantages that went to the previous apartment building owners. So there's all kinds of ways to make that happen, but I think the key is that it's going to take an additional funding from the federal government, because it's only the federal government that has the authority to create money.
Thank you.
Anyone else have any thoughts on what Joe has to say?
Yeah, may I? I do like the suggestion of your suggestion on as an alternative to rent controls, but for government buying it, I would stretch the idea that instead of bailing out the banks and the speculators, which is what happened in 2008, 2009, is we bail out the occupants. And to bail out the banks, what we could do is swap it with a bond whose present value is marked to market. But the future value, which will be earned through either interest or a balloon payment after, say, 10, 15, or 20 years, would approximate the former value of the real estate. And because we have saved the occupants from evictions, because they couldn't, the rents they will pay for the units that they're living in will now serve as the land value tax that could be used to pay or finance the bonds. That way, there will be minimal, if any, financial displacements. People don't have to lose jobs. There will be minimal disruptions in financial intermediation. And the government, by swapping the proper foreclosed properties with bonds, restores its role as a public housing provider. And I think this could work pretty well as a transition into land value taxation. That's just my comment, my suggestion. Thank you very much.
My response is, find a small town near where you live, or your own town, and try to get an airing with the city council and the mayor or somebody on their staff. I have tried like crazy to get my mayor to listen to me. She actually agreed to a sit down and turned me over to her economic policy person, who quickly kept telling me he didn't have time to meet with me. So this is the problem with ideas turning into action, is getting the darn, elected officials to sit down and listen to ideas that are somewhat out of the box from their perspective in terms of what, options they have pursued to try to mitigate these problems on an ongoing basis.
But what if we make, a consolidated international media release about such a strategy? Because I'm willing to go to a small town, particularly Lismore, which has been struck by floods, and I've met a lot of, it really broke my heart to see families living in parking lots in their
Yeah.
vehicles.
Well, here's what I
And,
want you to do. Forget about selling us or selling me. I want you to contact Rich Nymoen at Common Ground USA.
all right.
Get his email address. I'm sure Ibrahim probably has it, and write to him outlining what exactly you think could be done. And Common Ground works to try to implement land value taxation in cities all across the United States.
Mm.
And Rich might be the best person to talk to about that kind of idea.
All right, thank you. Ibrahim, can you just shoot me an email later? Thank you very much.
Sure.
So recession is ahead, is it not? We're on the cusp. We don't, we're either going to have continued rapid inflation, or they're going to use the traditional policies of rising interest rates and cutting back on credit in order to bring about a recession, in order to kill inflation. So as I said last week, if you're on the interest income side of things, you're feeling much better, as a saver, because now your savings are earning maybe 3.5%, where not all that long ago, they might've been earning less than 1%. So there's some portion of the United States population that is feeling pretty good about things right now. And for the bottom 65% of households, there's this problem of rising delinquencies, the potential for losing their home to foreclosure, personal bankruptcies. And all we need is a spike in unemployment. And this is, again, what is scaring me right at the moment is the increased value of the US dollar. US exports becoming more expensive to the people in other countries, declining US exports. What's that going to mean in terms of layoffs? And when and if layoffs start to happen and there's unemployment increase, that's going to put real pressure on the US Congress to approve some sort of a bailout, a universal basic income, or whatever to keep people afloat who are marginally afloat right now. So listening to me can't make you feel much better about the overall situation, but I don't know what else to say other than what the statistics tell me is on the horizon, particularly since I'm thoroughly convinced that the cycle exists and it will repeat as it has done. Now, here's a big difference in circumstances. Ownership of residential property is what separates most of us from those with net worth and those with almost none. So the Federal Reserve reported in 2019 that homeowners had a median net worth of around $255,000, while renters had a net worth of just $6,300. Now, $6,300 in net worth, that's whatever assets you have, savings, stocks, whatever. That's not much. It's not going to get you very far. Even $254,000, while it seems like a lot, if there is a property market crash, you could lose 15 or 30% of that within a very short period of time, because that's how much usually is lost when the land markets crash, depending upon where you're located. So the 60+% of households that have some equity in a residential property are much better off than renters. But there are a lot of people who have purchased properties now toward the top of the market. And if they put a minimum down payment on those purchases, they don't have this net worth, they don't have this equity, and it could very well disappear so that they're in a negative situation and not able to even sell their property to pay off their mortgage loan. Here's a chart that shows the total equity that's increased since 2020. It went $5 trillion in equity increased in just that period of time since 2020. That doesn't come from the increased construction value of households. It comes from the land market. And what the land market giveth, the land market can taketh away. What's interesting about this is also the fact that even when the homeownership rate peaked at 67% in the US, that was the high in 2007. That had no material effect on the overall wealth distribution. People got into housing, and some people who were in their housing unit for a long period of time, their net worth increased significantly. But a lot of people did not really benefit because they got into housing at the top of the market in 2005 and 6 and 7. And those are the people who were most at risk of losing their properties when we hit the recession of 2008. What rising values accomplish is, I think, to strengthen support for the status quo with respect to how property is treated for purposes of taxation. That's where we are with the fight for land value taxation. People who are benefiting the most from the status quo are going to resist change. If you're in California, you are going to resist with all your might the elimination of Proposition 13, even though every economist who's written about it says it has been a disaster for the California economy. And it is a source of a lot of the problems that they're having in California right now. But politicians know it's almost political suicide to try to change that system and increase the annual property taxes being paid by long-term residents. And here's another just look at the statistics. Break it down by race, and you get a very interesting picture as well. So the rate for white Americans is above the national average. For the country as a whole, it's 65.4%. For whites, it's 72%. For Asian Americans, it's 61.7%. For Hispanics, 51%. And for Black Americans, just 43%. So there's that issue as well as we experience economic hardship, that if you're Black, if you're Hispanic, and to a lesser extent, if you're an Asian American, you have less net worth to draw upon. So your opportunities to weather the storm is not significantly great for a majority of the households in those ethnic groups. Well, what's the larger issue here? I think, those of us who studied economics, or you have participated in these discussions in the Henry George School, is we talk about rent seeking all the time. It's an important part of the picture that there's a systemic reward to rent seeking in our socio-political arrangements and institutions. As income and asset ownership becomes even more concentrated, so does rent-seeking investment activity. What I mean by that is these are speculations that add no new goods or services to the economy, but generate inflated asset values far above what's justified by the capitalization of the asset's actual income stream. There's this huge pool of surplus money. Those in the top 15 or 20% of households in the United States, they have more money they could ever spend in their own lifetime, or even their children's lifetime. Well, they put it in the hands of a financial manager. What's the job of the financial manager? The financial manager's job is to earn the highest yields possible. And unless they're in some sort of a environmentally incentive investment club, or have some other kind of restraint on investments based on values and morality issues, like, for example, not to invest in companies that manufacture alcoholic beverages or tobacco products, that kind of thing. It's to earn the highest possible return and take advantage of every tax loophole that is put into the system, without really any major thought about whether or not these investment activities create new goods and services that are added to the economy. So that's one thing long term we have to deal with in terms of reforms. The Georgia's reform agenda deals with that directly, but does anyone here in anywhere, in any state, in any country, in any place, any kind of serious discussion about tax simplification and making the tax system distinguish between earned and unearned income? In the United States, what that would mean, and I'll talk about this when we're later in the lectures, we ought to be, number one thing that we could do is eliminate the distinction in the rate of taxation on so-called capital gains versus ordinary income. Because, as I've been talking over and over in this course, capital goods don't actually increase in value, they depreciate. And so how can we call an increase in asset value a capital gain? It's certainly not an increase in the value of capital goods, but that's what we call it. And it sounds like because they're capital gains, it must be good for the economy. And that's all I'm trying to get to here with this little, sign. Actual capital goods, equipment, machinery, buildings, technologies depreciate rather than appreciate over time. And so by treating these gains as capital gains and giving them preferential rates of taxation, our economy takes on the characteristics of an unregulated gambling casino. Joe.
I certainly agree with you in principle, but it's a bigger picture than that.
How did I know there was a but coming?
Yeah. So stocks qualify for capital gains. You own, an Apple 20 years ago. The company has grown and added to its, and the sale of that growth, both in revenues and size and employees and so forth, does lead to a great gain. And when it's sold, it qualifies for a capital gain. And I would agree that in that situation as well, that income is no more special than labor, and therefore should be taxed at the same rate. And also there's the factor of what the capital earns when people own it and use it to earn income, to produce things and generate income. But in principle, I still agree that despite that, broader perspective, everything should be taxed at the same rate.
Well, this could take us off onto a tangent, but I'm going to risk it anyway. Most of the stock that is sold from one investor owner to another investor. And so you have the market based on the supply and demand of the stock that's being brought to the market. And Wall Street investment managers, asset managers have a great deal of effect on the trend in the value of that stock, independent of the actual performance of the business that has issued the stock. I mean, if Fidelity decides to go on a buying spree on a given stock, even if that company has not produced any kind of increased revenue for the last couple of quarters, the rest of the investment community is going to think the analysts at Fidelity must know something. We better get in on this before we can't. So you have these investors and companies that have hundreds of billions of dollars of shares of stock that can move the markets. I don't know what a solution is, but I do think that gains on the sale of financial assets should not be given beneficial treatment under the tax code. That's at least have a level playing field against wages and salaries. And
absolutely, I agree 100%. I agree 100%.
But I don't know. I'm not convinced that the values, the share values of corporate stocks today represents any fundamentals, any capitalization of an income stream. If there was a law that required a corporation to distribute profits to all of its common shareholders above what was actually required as retained earnings, then you could say that, okay, I'm getting $10 a year per share as dividends, and I could capitalize that based on an average rate of return that's acceptable in the marketplace. So if the market's on average yielding 5% and I get $10 in dividend income, then my share of stock is worth 20 times $10 or $200. And then I would say there's something substantive, but a lot of these corporations don't pay any dividends whatsoever. So you're investing in a share of stock not based on its income stream it's generating, it's based on its unrealized capital gains that it's generating because of the casino. That's my view. For what it's worth.
Could I
Now-
share something?
Yeah, go ahead.
What I've observed in the top 500 corporations, you'll hardly find any declaration of land in their balance sheets. And instead, you will find investments in subsidiaries. And when you look into the subsidiaries, you'll find out a lot of them are real estate subsidiaries. So when you look at the financial statements they submit to the SEC or equivalent, the book values look very far from the market values of their shares. But I took a deeper poke at Apple. I'm still looking for my files of that. But when I looked at one of their real estate subsidiaries and revalued it based on their projected earnings and gains in certain projects and incorporated it into the balance sheet submitted to the SEC, suddenly the book values go up to approximate the market values in the board. So
You're talking about, you mean the market capitalization of all outstanding shares?
yes, the book value is normally very far away from.
Yeah, well, first,
But-
unless
but
I'm wrong about this, as I recall, you do not have to mark land assets at market value. You put, they're on your book at cost of acquisition.
yes, exactly.
So,
That's the way they that's how they camouflage it. And I think a lot of people, a lot of market analysts do exactly what I just described. They look into the subsidiaries,
Yeah.
the real estate subsidiaries of companies, and when they find the hidden values of those subsidiaries, it does approximate market.
we have to give tax accountants a lot of credit for gaming the system.
Yeah.
Okay, and so every CFO and a team of people working with that CFO is doing everything he or she can to maximize the gains from the assets that the corporation or any business holds if they're doing their job correctly.
Mhm.
And they're going to game the system to the extent the law permits. And sometimes they're going to game the system in a different way because they can get away with it. For example, generally speaking, it's pretty well known that corporations, international corporations, report their revenue where the tax rates are lowest and report their expenses where the tax rates are highest. So, and how do the auditors in different countries, get hold of these consolidated financial reports that aren't consolidated and then figure out what the real income and expense streams are for these corporations. And in the United States, it's particularly been a problem because the Internal Revenue Service has been defunded. And I don't know what, if there's a similar situation in other countries, but we've decided in the United States, whenever possible, to lower the ability of the Internal Revenue Service to conduct audits of its major corporate entities. So where are we? We got about 10 minutes left tonight. I wish I could leave us in a situation where I thought we would be politically able to make our way through some of this. And when I come back from my travels, we will talk about some of the issues, some of the options that we might have that could be politically achieved within a shorter period of time. Victor.
Right. I was wondering, going back to your comment about capital gains tax, why not? It would seem to me, if you want a solution to this, you would simply tax at a progressive rate all profits wouldn't that solve it much more quickly than a particular tax aimed at one single asset?
Well,
I agree
um,
with you, but
no,
I'm just saying.
yeah, I'm not, yeah, okay. We're getting deeper into this conversation than I anticipated doing that tonight, but that's okay. It's real important because I do agree with you that what we need is progressivity. There are a number of options that have been put on the table and are being pursued now, particularly at the state level. Some states have begun to implement a progressive tax on gross revenue. So in my mind, there's some good merit for that, because what it does, a progressive tax on gross revenue would tend to capture unearned incomes at the highest levels. If we assume that entities that have such a high level of revenue are getting a lot of that out of rent-seeking activity and other privileges under law, then a progressive tax on gross revenue would begin to publicly capture more of that revenue. And the MMT folks would say, well, that's not necessary for revenue raising, but it is a good idea from the standpoint of social policy. So it takes away some of that unearned income and puts it back into the public coffers. I think that moving away from taxing business profits, which reward entities for higher expenses. So if you take the expenses out of the equation, it means that efficient companies whose expenses are lower, maybe don't have as many junkets for their executives, all sorts of other, high value benefits that aren't justified by market performance, that now you're treating all these companies pretty much on a level playing field, and just looking at their virtual size as a way to capture more public revenue based on an assumption that there's a distinction between what's earned and unearned. So that's what I would argue is the better option to replace a business profits tax right now. But from a standpoint of individuals, I would say all sources of income should go into the pot. And then you can, our individual income tax could be established in something of the same way, in the sense that we could have a high threshold of exemption, say the national median income. So in a single person household, the first $60,000 of income would be totally exempt. We could have tax simplification by eliminating all other exemptions and deductions, and then have a very graduating rate of taxation apply to higher ranges of income. And so again, with the objective of once you get up to a certain level, you're basically capturing a high percentage of income that is rent derived, that is unearned versus earned, that wages and salaries are going to be untaxed, and income derived from capital gains and other speculations, and that would be subject to a much higher rate of taxation.
But again, I'm asking why you're distinguishing between revenue and income rather than simply profit. If you went to a graduated rate like we had in the 50s, up to 90%, wouldn't that in effect, whether it's a company or an individual, solve much of the inequity that we're going after? If you're going after inequity, I'm assuming.
Profit is an accounting term, and it is derived based on what a company's CFO and its accounting staff is able to do to hide as much revenue as possible and maximize the expenses taken. So I think a tax on profits is the wrong way to go. A tax on gross revenue creates a level playing field. Two companies that have the same gross revenue, and one has a much higher expense base than the other, they're both taxed the same, which is a great incentive for the company that had higher expenses to become much more efficient.
Well, now you're talking about loopholes, however. Yes, the accountants can play games and they can hide uh, the income, the net profit, the actual profit by playing accounting games. And Luke, it's a longer discussion. I think from the point of view of Thomas Paine, the bigger solution would be to even go back to eliminating charters that give benefits to some portion of the population. In other
Well,
words, he said that charters, corporations do not give rights. They are in effect taking rights away from other citizens.
yeah, Victor, we get, here again, my answer to you short term is the perfect is the enemy of the good. I'm an incrementalist. I mean, yes, exactly. I mean, I'm with Payne. I'm with Henry George. But getting from where we are to where that perfect need is never going to be easy. There's always going to be intense resistance, and so I think we have to slowly work incrementally to get there and convince people that the incremental changes that we're making are beneficial and moving in the right direction. And when that proves to be the case, then we ask for more. They work for more, and we keep working for more. And that's what I got this sign up here now for tax credits. I mean, we have tax credits are an interesting vehicle to get people to make decisions that are beneficial to the community, but are also beneficial to them from a standpoint of their tax obligation. So even with a tax on gross revenue, there still might be an appropriate use of tax credits for specific socially motivated investments. So, I mean, the states use tax credits to attract and direct investments. They right now, they compete with one another in what I would call a zero-sum game to try to attract business from other states. So, when GM is looking to build a new, assembly plant, where are they going to do it? Well, they're going to go to different states and say, what do you have to offer me? Well, we're gonna offer you these tax breaks. We're going to open up an automobile education center to train all the people that you need to have working there. We're going to build new highways to connect your plant with the rail lines, whatever. I mean, that's what states do now.
Well, let's leave it with incrementalism as, in my view, not part of the solution. In other words, I would say let's sweep the oligarchs into the dustbin of history. If that's the goal, I think people could understand the source of the problem, and how we eliminate it is may not be incrementalism. It might be something a little bolder, like what the founders had in mind when they got rid of oligarchy temporarily.
Well,
all right,
Victor,
I look forward to you coming back.
It sounds like there's got to be some kind of a political movement that currently is struggling to get off the ground. I mean, I would say the one part of our society that could achieve the most toward what you're talking about without violence is the trade unions. If the trade unions, if the unions in this country could once again regain the kind of prominence that they had, in the 50s and 60s, that they might be able to push a reform political agenda. But even the unions, don't seem to be very unified in what they're trying to accomplish, because they're competing with one another. I mean,
A topic for longer discussion.
yeah, it is, and it's beyond my sense of what is possible. Hopefully the last 2 weeks after I return from my trip to Europe, we'll talk about some of this stuff in more depth, and we'll have a lot of chance to air it out. And hopefully some others will join in this conversation and share your opinions and your thoughts, rather than listen to the 4 or 5 of us who, we're having these conversations. It's 8 o'clock, so I'm going to stop here. But I'm open to any, conversation that you want to have. And some of you who've been quiet all night, what's on your mind?
Much time do you want to allow for further discussion?
Well, I'm okay. I mean, I don't have any, I don't like to keep Ibrahima too much longer after, 8 o'clock. He's had a long day. And so,
Let's
10 or
say 2
15.
minutes, Ed.
Pardon me?
Let's say 5 minutes.
There you go. Just a few minutes. And I'd like to hear from someone who hasn't had anything to say tonight, if that's
And I'll put my 2 bobs worth in if you like.
okay, Keith.
Yeah, I've been listening with, very interesting, very good production tonight. But I got to take issue with a little bit with your views on rent control.
Okay.
I'm a property investor. We've got 2 properties at the moment. We have had up to 5 over the years, but property investors, like me, I just represent the average investor. We invest to make money, and we do it for our future. And we put a big risk. Like I mortgaged my house to buy the first property, and I continued that mortgage. I paid it off years later, but that's what you do. There is risk, and I just don't see how it's fair to put rent controls on people that are providing a service. I provide a service to 2 tenants that I look after very well because I value them. A good tenant is like a diamond. You've got to look after them. But if you have rent control, you get people that just don't care. I've had people like that were paid for by the government, and they're the worst tenants you could get. They just don't care. So I think there's the other side of the coin too.
Don't misunderstand me. I'm not a big fan of the idea of rent control. My basic position is I'd like to see local government acquire some of these large buildings and turn it into public housing, or turn it over, to a community development organization or some nonprofit to run it. But in the short run, I don't know how the United States finds 7 million housing units that can be made available for, lower income households.
Yeah.
Kelvin.
The problem will be solved if they removed all taxes and just had a tax on the increase in the land value.
Of course.
Yeah,
But
that would solve everything. Yeah.
look, I've said this before. If you live in the United States, in the state of Pennsylvania, which is the only state that has a constitutional amendment permitting the a higher rate of taxation to be applied to land values than housing or building values. It's the only state that has that constitutional amendment. And only 20 communities or so have opted to go that direction. And every time a new mayor is elected or the city council changes its membership, there's the possibility that those people who are just elected might vote to go back and reduce the tax on land because they've been influenced by land speculators, major landowners in the community, whatever. And not only that, but if you live in some communities, take the state capital is Harrisburg. Harrisburg, the city of Harrisburg taxes land at a rate 6 times higher than it taxes building assessed values. But if you live in the county taxes land and buildings at the same rate. The school district taxes land and buildings at the same rate. And so it's the effect of the tax that the city imposes is dramatically reduced because these other two, what's the right word? Coterminous taxing bodies do not follow the same tax regime. This is in the best circumstance that we have in the United States. Now, maybe the new tax law in Germany will work much better, and maybe our colleagues in Australia, in Australian cities, will be able to get land value taxation, the power of land value taxation back as it once was. Kelvin.
I just wanted to add, I've been listening, and it's great conversations every night. We have these, but I just want to add, I'm from Boston, Massachusetts. I'm a small landlord here, and they did try rent control back in the 70s and 80s. I wasn't alive at that time to know, but I know that in 1994 they outlawed it, and according to what my research is, it caused a lot of issues with landlords. As soon as they put in rent controls, landlords ended up taking off the market, quote unquote, a lot of the units or converting them into condos.
Yeah.
So it didn't really work. Although the current mayor, we just got a new mayor elected within the last year or so, whatever it was, and she's trying to investigate rent control again. But this time she's doing it with a task force, and they're looking at seeing if they can increase supply along with the rent control, because otherwise you're not gonna solve the problem. However, in Boston, I'm also part of a nonprofit real estate development corporation, a nonprofit CDC, and it's extremely expensive, per unit cost for us to develop an apartment in the city of Boston, especially in some of the underprivileged, underserved communities that we address. So it's like $650,000 a unit to build and develop, and typically we sell them at a loss. So, or we'll rent them out at a loss. But it would require a lot of government funding for us to be able to expand, or any of the other CDCs in the city of Boston to expand their services.
I remember at one time there was a report, I forget who produced it, but an economist were looking at Boston, and that 2/3 of the land in the city of Boston was tax exempt because it was institutionally held by universities, hospitals, or churches, etc.
Yep,
So-
we have a tremendous amount of those.
So, I mean, you have really a very small land area that is available for development,
Mhm.
and then a small land area that is available to provide, public revenue. So I wouldn't expect, the situation in Boston to be easily improved unless Boston could annex some of the surrounding communities.
Mm. Yeah, and even those communities tend to be kind of heavily populated.
Yeah.
You have to get further out. One of the things Boston's trying to do to increase supply is and I know California is doing this as well, but they're trying to institute this additional dwelling unit program to get landlords, like for example myself, I have a 2-family and I can convert it to a 3-family, like
Yeah.
do that, and they're giving incentives to do things like that as well. So I know they're trying, but it's just what the demand is just far outweighs the whatever supply is left on the market right now.
A common story, Kelvin, and thanks for sharing it. And I will let yours be the last comment of the evening. And I hope we've given everybody a lot to think about for the next 2 weeks. And I'll plan to see you all back here in 3 weeks. Thanks a lot.
Thank you.
Thank you very
Thank you.
much, Ed. Thank you for coming. And I'd like to remind you quickly that we started a new course with Professor Nick Tiedemann from Virginia Tech. And the title is A Theory of Economic Justice. We had the first session last night, and we'll be rolling this out for about 7 weeks, I believe. There might be a second part, but for now we have only 7 sessions scheduled. So if you haven't registered yet, please go ahead and do so. Thank you and good night.
Thank you.
Good night, all.